Last week, the S&P 500 logged a more than 6.5% loss. So the index now down more than 9.5% for the year so far. Some say we're at a pivot point in the market. Investors worldwide pulling out $92 billion from stock funds in developed markets this summer, matching the lowest levels from the financial crisis. With more on what these data mean, we bring in Paul Hickey. He is the co-founder of Bespoke Investment Group. Paul, always glad to see you here on the Inside Track. Thanks for coming in.
Thanks for having me.
So to what extent is the U.S. market really suffering from what's happening in Europe? I know you've been pointing out this Monday factor.
Yeah, it's from an old movie. The market's got a bad case of the Monday, so to speak. Every morning we come in, and news in Europe dictates how the U.S. markets perform. And if you look the last 11 Mondays, the S&P's been down 7 out of 11 of those. And it's really a shame because we're pretty much handcuffed by the events in Europe. But at the same time, while, I mean, things aren't not great here by any stretch, I would think that the U.S. is a beauty queen compared to what's going on in Europe.
You've been watching metals as well, because I was reading through your research this morning. I mean, what do these declines in copper and gold, what are they telling you about where we're headed?
Well, I think the declines in the commodity markets last week, one of the big drivers of that was the weak PMI out of China, and the thought that the U.S. economy is slowing down, and that really has a hit to copper. Gold is somewhat more puzzling there, just because for every reason you bought gold in the last 2 years has come to fruition this month, and it goes down. You know, it's the most liquid investment for investors. Buy the
mystery, sell the history.
Yeah, exactly. So, but it's one of those things where that's what makes the market frustrating for investors. Is you would think everything's lined up perfectly and it sells off.
So you mentioned China, though. I mean, with the idea, do you think there's more and more evidence that China's just mammoth economy is actually slowing, and enough where that's going to affect global economic growth?
Well, when you have the European economy and you have the U.S. economy both slowing down, China is a major driver of its economy is exports. That's going to have an impact on China. You have contraction in the PMIs. I mean, we're not really having cratering in these PMIs. Granted, people will question these statistics from the government, but at this point, I mean, I don't think it's a worldwide, say, depression, so to speak, that some investors or the commodity markets would be saying right now.
Paul, you were telling us earlier that U.S. investors are somewhat prisoner to Europe, but there has been one interesting divergence. I'm not sure I can really call it a divergence between the pattern of trading in U.S. stocks and European stocks. U.S. stocks have followed European stocks lower, but we don't keep making lower lows, whereas the stock 600 anyway in Europe keeps making lower lows. Every time it goes down further than it did the last time. Is that a positive technical indicator?
Well, I mean, it's positive. In the short term, what we're seeing is the S&P didn't make a new low last week. It came very close. The internal indicators that we look at didn't come close to making the lows they made in August. So from a short-term perspective, that's somewhat positive, and you know, it's something we can hang our hat on. From a longer-term perspective,
even though there's not much, right?
Yeah, I mean, yeah. I mean, now we're starting to talk about how seasonality plays a factor for the market, and we're getting into a good seasonal time of year. And when that's the only thing you can point to, you know,
the weather for stocks is a pretty bad correlation.
Right. But from the longer-term perspective, though, if you look at the U.S. markets, we are outperforming all the other G7 countries this year, all 4 BRIC countries, which are your proxy for the emerging markets. So while we've been told for the last three or 4 years that you have to look abroad to invest, the reality is that staying close to home has served you better this year.
But best of the worst isn't a really strong case for investing in U.S. stocks either.
No, best of the worst. If you have to go somewhere, the U.S. is the best game in town.
But that's a really good point, because we have been saying for these years, look to the east, especially to China. We know many people piled into ETFs. I mean, there were many investors trying to play this growth story. And to your point, it really hasn't paid off.
Right. I mean,
in a general sense.
Right. Longer term, if you look at say the last 10 years, the MSCI World ex-U.S. versus the S&P 500, for almost this entire decade, the U.S. underperformed. And then since 2008, if you look at that relative strength, the U.S. actually bottomed, has been trending slightly higher. So just as the tone of and advice from strategists was to go abroad, the U.S. has started outperforming.
Paul, you used to be a trader, right, at Salomon Brothers, and now you're sort of in the business of providing perhaps longer-term advice.
Right.
Try to straddle the line, though. What would you be doing as a trader versus how you would be investing long-term right now?
Well, I mean, as a trader, if you just look, I mean, for a trader who's good, it's the best time. It's the great time. You look at last night, the S&P futures were up over 1%. They came in, and now they're starting to rally a little bit again. So I mean, there's this volatility is great. It's the individual investors who look at this and get scared.
Should you be scared, though? Should you be on the sidelines? Should you be waiting until something cracks in Europe before you decide firmly whether to get back in the market, assuming, of course, you have some cash?
If you have the cash longer term, just like in 08, in October of 08, the market still went lower, but a year and a half later, we had rallied back. So for the longer term, one of these strategies of just strategic investing, a little bit at a time, you'll make out better here, but. The fear is, on the part of investors is palpable, and you have this, every day you see these major headlines, and Larry Summers saying it's the most threatening time he's ever seen. It's hard for the individual investor to be positive there.
And it's hard for professionals to get the timing exactly right, and it's even harder, arguably, for individual investors to get the timing right. I know you've been looking at financials as well, essentially saying Operation Twist is going to hurt a group that is already down. We know financials are down something like 27% so far this year. Is there any kind of silver lining out there for this group?
Well, if you look at Operation Twist flattening the yield curve, whatever can go wrong for the financials has gone wrong for the financials, and this just seems to be piling on. The yield curve and the financials move hand in hand. So when the yield curve flattens, as it has been for most of this year, financials get hit. The one silver lining is if you look at the last two times the Fed has sought to lower long-term interest rates, QE1 and QE2, long-term interest rates actually went up both times. So, what sounds good in theory, but hopefully, for the financials, rates don't come in too much.
Paul, thanks so much for stopping by. Paul Hickey joining us there, co-founder of Bespoke Investment Group.
Good to see you, Paul.
You too.